Right, so these are very, very busy individuals joining me on stage today. Augustin, lovely to see you. Where have you flown in from?
I haven't flown, I just drove
You
from
just
Basel.
Okay.
So that was easy.
So the thing is, whenever you look up what Augustin has been doing, you are all over the headlines at the moment because you've had a great deal to say about the current macroeconomic environment. We'll get to that in just a second. Thomas, you've been very busy talking to, obviously, with your work at the Swiss National Bank, and certainly last week you were busy because there were other central banks that decided to hike rates. I think it's been quite a time for you as well.
Well, as for all central bankers, it's a very demanding time. Many challenges, high inflation, very complex situation. So that was exactly what we had to discuss last week.
Yeah, to jump in and do something. And we will talk more about the sort of reasoning and what your outlook is going to be just up ahead. And Ravi has been fighting off something. It's good to see you here with us, joining us. Unfortunately, we missed you at the speakers' dinner yesterday, but it's wonderful to see you today. Are you doing well?
As well as I can, under the circumstances. Yes, thanks. Good to see you, Manisha.
Okay, well, hang in there. I'll be very gentle with you, so nothing that you can't handle. Well, look, thank you again to all of you for being here. I think this is going to be a really fascinating conversation. Augustin, I'd like to begin with you. You have been very vocal about the current macroeconomic conditions and, of course, the impact of geopolitical events and how they're influencing financial markets at the moment. You've recently talked about entering a new inflationary era. I'm quite interested to know what you meant by that and what the implications are going to be for all of us.
Well, thank you very much for the question. Yes, of course, we have been thinking a lot about inflation. No, I have this. Does this work? Yes?
I think so.
I have it as well.
Someone's struggling. Oh, there we go. Is everyone all right with their mic?
We're all fine, or?
There we go.
Ah, okay.
We're good. Excellent.
No, yes, of course, we have, particularly in the central banking community, we have been quite busy thinking about inflation. Now, something that we tend to forget in the hype of the most recent figures is to see a little bit where did we come from. And I mean, we have just to go 2.5 years back, and we were in a situation where the concerns among central bank governors and central banks per se was how to bring inflation up to target. We were in a situation where we were concerned about the secular forces keeping inflation down, given the impression of a lot of lassitude to implement monetary policy. And in that context, we got first the COVID shock. And the COVID shock was very unusual. It generated a huge, very sharp decrease in GDP activity. There, the real urgency everybody was calling for was to implement or deploy all the instruments that we had at our disposal to smooth the business cycle. And certainly monetary authorities responded, as well as fiscal authorities. So the response was appropriate. Now, at the same time, probably one aspect that we probably didn't get the right dimension is all the dislocations that COVID was going to bring. Dislocations of markets, as we have seen the distortions in global value chains, problems with some particular commodities, shifts in demand patterns, and well, of course, that complicated a lot the picture. We were very lucky that we had also a very, very fast recovery, but that together with a very, very fast fiscal response generated an environment where inflation spiked up quite markedly. For us in the central banking community or central banks, and I was many years central banks in Mexico where we had a lot of inflationary shocks, there is always a debate of how to deal with transitory shocks. Which ones are transitory, which ones are permanent. In this case, we had transitory shocks, I think, but they're going to be persistent. So together with all the previous configuration of a very strong recovery that also was not precedented because we were expecting a long and protracted recession, we had unanticipated problems from the point of view of dislocated markets and global value chains, commodity prices shocks, aggregate demand shocks, in an environment where monetary policy was accommodative for good reasons. And then, to make things even more critical, at the beginning of this year, we had the Russian invasion to Ukraine, and that complicated the whole picture dramatically. So what we have seen in what we have been studying this with a lot of detail, and something that you see is that when inflation is low, inflation tends to be self-stabilizing for many reasons. But when inflation starts to get up and being more permanent, you can enter into a transition phase where it's self-reinforcing. And if you don't have forceful monetary policy action, you might end up in another regime of higher inflation. So what we are looking for is precisely to limit as much as possible that transition to a high inflation regime and basically avoid it, and that means to avoid inflation to be entrenched. So a forceful action from central banks is called for, and I think one of the key aspects is to prevent to enter into a price-wage spiral, because then is when things get more complicated. But yes, I think that we are in a different environment than I would say in the last several decades, and therefore this requires a more determined, flexible response by central banks.
So on that note, that's a great segue for me to bring you in, Thomas, and let's talk about how the conversation went in the lead up to the latest hike. Was there ever any debate? And were you trying to avoid this higher level of inflation that Augustin is referring to?
Mm-hmm. Well, exactly. I think I fully agree with almost everything Augustin said. We have a very complex situation where we have all these negative supply effects that increase in inflation. But of course, we have also the steam of a very expansionary fiscal and monetary policy coming out of COVID. And this combination results then in relatively high inflation rates globally. This is also the case in Switzerland. So far we are still lucky. Inflation is relatively low, but nevertheless the same pressure as everywhere else are also present here. And we also see how important price stability is. So if you look at these political discussions everywhere, but also in Switzerland, how people are impacted very negatively by inflation, I think it's our duty to look at that very, very clearly. And it's not only supply, it's also something that we see it's broader, so that we see many prices that are not immediately impacted by energy prices are also increasing. And we see this a certain risk of second and third round effects. So we came to the conclusion that it's the right time to tighten monetary policy. Well, we still have negative interest rates, and in a way this is still expansionary, and we should not forget that by just keeping rates unchanged and with having a much higher inflation rate, monetary policy is not neutral or not unchanged, it becomes even more expansionary. So by increasing rates, we adjusted to some extent our stance of monetary policy in the right direction, and we will see whether this is sufficient or not. We published a new inflation forecast, and if you interpret it correctly, you see that there's a certain need probably to tighten further. We do not exactly know when and how much, but this inflationary pressure is not yet combated completely. So we look at that very carefully, and we are completely aware of the complexity of the situation and of the fact that we have this mix between supply and demand shocks. So we will go from quarter to quarter and see what is the right adjustment of our monetary policy.
Yeah, and just to extend on that a little bit, of course, that is the difficulty, isn't it? It isn't that there was some sort of problem with central bank policy or anything like that. This isn't just a monetary policy solution that can be applied to the current rises in prices. Now, of course, I'm not just talking about Switzerland now. I'm going to be talking, and I'm appealing to your wider knowledge of the financial system. What do you do in a situation like this? Because we're also talking about the geopolitics, we're talking about a world in transition. Tomorrow, we're going to be talking about the reach for net zero. All of this has put everything into a state of upheaval, and we're seeing the impact of it in many different ways in our everyday lives. Surely that keeps you up at night. How do you mitigate against that?
Well, this is exactly the complexity of the situation. So monetary policy has almost no impact on these supply problems. So we know we have an energy supply issue. So all the energy coming from Russia is not anymore available or much at higher prices. So there we need different answers. So this is not in the domain of monetary policy. This is rather with governments that they should help in order to increase the energy supply. That will probably make our life easier as well. And then we have all the other supply chain issues from COVID, still COVID, with all the, I think, the problem with the supply of goods coming out of China at this moment, which is also limiting and the supply and increasing inflation. All those issues play an important role where we have very little impact. But we have to be aware of the risk that suddenly we have these second and third round effects, which is also understandable because nobody wants to pay the price for those issues and everybody wants to increase its own price or its own wage, etc. There we have to be aware and take the appropriate measures so that we can limit the risk that inflation suddenly will go up much, much further than necessary.
Yeah. In a moment, I want us to move on and talk about what's happening in the crypto space. And you know, obviously, this is a session that's titled The Future of Financial Services. With that, Ravi, I want to just bring you in with some of your thoughts on where we go from here. If we're talking about a new inflationary era, we're talking about limitations and what you can do in terms of monetary policy. What are your thoughts on this?
Well, Manish, I think it's...
I think you need this one.
Pass the mic game.
Yeah. Quite amazing that...
It's good. We can hear you.
It's good?
We can hear him, right? Yeah, hands up. Yeah, we can hear
Okay,
him.
great. It's quite amazing, isn't it, that here are three of us whose number one preoccupation at this point is inflation. And we took the trouble to come here to talk about the future of financial services. I think that shows, I think, central banking at its best, that even as you're preoccupied with fighting the current situation, you're thinking ahead to the future. I mean, on inflation, I think everything has been said so well. It will probably get worse before it gets better. But as long as central banks do the right thing and there's continued monetary policy tightening, inflation can't survive for extended periods of time. We need to be clear about the objective. It is not so much to filter off the energy shocks, because that you can't, right? Massive increases in energy prices and food prices. The focus of monetary policy is always to address the second round effects, where it starts to seep into the rest of the economy, and you have generalized price increase. Now that's harmful. And especially, as Augustine said, you don't want to set off a wage price spiral. And that's where monetary policy comes in. And I think through that signaling and non-accommodation, we should get inflation down. But a very important point that, again, Augustine makes, I don't think we can expect inflation to come down to the levels we've seen before. It's going to come down and stay at fairly elevated levels. That's my own guess. There are people who disagree with that. But I think in any case, as central banks, we need to be prepared for that eventuality, that inflation, while it comes down, stays higher than it has been in the past. And that enters a whole range of other structural forces at play. One of the forces that I think can help to moderate that is technology. Technology can reduce cost, increase efficiency, increase business processes. And I think that's why we are all here, because we want to increase efficiency in our economies and lower costs. And the crypto phenomenon, or the crypto ecosystem, is one way in which we can do that. I think the timing of this conference could not have been more immaculate, because here we are gathered to celebrate the crypto economy when actually there's a bloodbath going on. I think the crypto industry is at a crossroads. The choices we make now is going to determine the future. We are seeing an unprecedented sell down, price collapse, and bankruptcies across many crypto firms. And this is not necessarily bad, and I say this as a regulator and a central bank. It's a great opportunity to separate the wheat from the chaff. I think there has been a bit too much speculative frenzy. And if you think about what the blockchain, what the asset tokenization, smart contracts can do by creating economic value, enhancing financial inclusion, transforming business processes, making lending, payments, and so on easier and faster. I think many in the industry, if I may say so, have missed the plot because the crypto tokens that are powering these blockchains have taken a life of their own, and speculation in cryptocurrencies has, I think, brought great damage. The lives of investors who've lost their money is one, but the waste of resources is another. So I think we have a great opportunity here in this conference to reset the path towards actual business transformation. And just to give by way of example, that's one of the things that the MAS is trying to do, even as we take an increasingly tougher stance against retail investments in cryptocurrencies, which we think is a terrible idea. It's important to promote the technology, the industry, and use cases, be it in asset tokenization, decentralized finance, and so on. So we just launched last week what we call Project Guardian, which is a way to apply asset tokenization to financial assets and to see by creating a pool of tokenized deposits and loans, we can generate greater economic value at lower cost, at lower risk. I think we need to step up these kinds of innovations and experiments so that we can make breakthroughs in applying this, I think, this technology, which has fairly good potential. Thank you.
Yeah. In fact, let's extend on that. Just yesterday, there was a report published by BIS. And in this report, Augustine, there is a lot of attention given to the possibility of this crypto space and the experimentation, this kind of some of the lessons that obviously Ravi and his team will learn over at MAS, we'll learn from those. But what came out of the report was you still need a real world anchor point when it comes to this space. Can you explain to us what was that about? What led to this portion of the report in your conclusions?
Yes, of course. Well, in the last 3 years in the BIS, we have been investing a lot in innovation, a lot in bringing about ways for technology to apply it in a more thoughtful, agile way into financial services, into banking systems, and so on and so forth. And the BIS has made a huge investment to the BIS Innovation Hub, and I'm very pleased to be here with two of my very original founding father club members, which is Ravi and Thomas, because we started with 3 centers, having precisely as hosts the Monetary Authority of Singapore, the Swiss National Bank, and also the Hong Kong Monetary Authority. So, I mean, the issue is that I think it has a lot of value to think in a very forceful way, in a very, how would I say it, in a very careful way. How can we apply technology better? I mean, I mentioned the thing of the hub because we are all pro-technology, we are all pro-innovation, but innovation cannot be an end in itself. Yeah. You know, it has to build on what we have learned for many, many years. And you know, if you study the history of central banking, the history of financial services, you see that we have gone through many cycles very similar to the ones we're going right now in cyber. I think one of the key aspects, and I think a lot of what is going on right now, is precisely the idea that we need a technologically adequate representation of money and that should be central bank money. It can be CBDC or it can be wholesale central bank money, even if it's not precisely CBDC, based on which all this technology can be applied. I think where things have gone in not the right way is in the idea of coming with another currency. I mean, a lot of what central banks do has to do with trust, and trust in the value of money. And as a matter of fact, this has a direct relationship to our previous discussion with inflation. Why do we mind about inflation? Because inflation is eroding the purchasing power of money. And what is an institution like the central bank doing? Well, using its instruments to preserve the value of the money. So central banks have many different institutional capabilities, instruments that have been formed through decades, centuries. We have already central banks that are three centuries old. And we have learned many of the lessons that we are learning today. For example, a big issue right now is with stablecoins. Just the name of it, stablecoins. Why do we need to underline stable? Because the coin by itself, the way it has been created technologically, that doesn't assure the value of the currency. Now, when it's stable, it has to import its value from another currency, and traditionally that's sovereign currency. So why do we have to go through the whole process of inventing an adequate currency when we already have one? So I am 100% on board that we need to have a very strong platform to develop a future financial system that has the flexibility, the nimbleness to incorporate all the technological developments to make it efficient, sustainable, to make it exciting. But it has to be founded. It has to have very strong foundations. And in that foundation, for me, what central banks bring to the table is a key aspect. No, we have gone through it. We have learned. So why don't we construct on it? The technology is great. Technology can bring us to another level. As a matter of fact, I think that as central banks, and that's a point that that chapter that you mentioned brings about, is that we need to start thinking about what is the future financial and monetary system we want. At this stage, obviously we're very busy dealing with inflation and other major financial stability issues, but it is important that we can start thinking in a more aggressive way. How can we incorporate all these dynamics that the innovation is bringing to have a healthy financial system? We need to have a very active dialogue with all people like the ones that are here represented, to learn the best of what technologies is going to join forces and build a financial system that has as a platform what we have learned and that what has allowed financial systems to grow in the last decades and century, which is basically the foundation of central bank. So that's the key point we want to drive home. And for us to be in this type of forum is great because we want to capture that dynamism and through time apply it for the better of the financial system. And that's why you also have partnered with the Swiss National Bank, with the MAS, with the Hong Kong Monetary Authority, now with the Nordic Central Banks, with the Bank of England, with the New York Fed, Bank of Canada, precisely to have presence in hotbeds of innovation, have dialogue with all the people around, and try to really forge that vision, strong vision of a future monetary system that incorporates all the leading technology, fulfills all the needs of society, but is this built on strong foundations.
Yeah, I want to tune into what you were saying there about having an aggressive plan, because there are some who might look at this and current experience and bear that in mind and say, it's very reactionary, our position at the moment. It's great to have some proactivity and to have a plan. But, you know, earlier, some of our audience would have listened to the CEO and founder of Binance. Well, Binance started 5 years ago. And look at its tremendous pathway in just 5 years. We've got worlds, as sort of a new sort of financial parallel that is growing so fast. Thomas, how do you keep up? How do you manage and therefore create an aggressive plan that keeps up with such rapid change?
Well, I'm very optimistic that we will converge to the right path. I believe the unit of account, so central bank money, a Swiss franc, a US dollar, or a Singapore dollar, is really a very strong asset. And at least so far in Switzerland, nobody would accept the salary in Bitcoin or a mortgage in Bitcoin or something like that. So the unit of account is absolutely clear. And as long as central banks manage to maintain price stability to fulfill their mandate, I have no fear that this unit of account will go away, and most people or financial markets will use many other units of account and not the real one. So not all money has to be central bank money. I think that we need a central bank money that is very safe. For many transactions it makes sense, but we have also today commercial bank money, the bank deposits, and they fulfill very important tasks as well. And now we have this new form that we can tokenize money, and we have these stable coins. In my view, we should not be afraid of stable coins, but we should regulate them in a very similar way as we regulate banks. So it's very similar. If you issue a deposit, this is a promise to pay Swiss National Bank money, cash. When you go to the bank, you can have banknotes. So this is this promise to pay in central bank money. And the stable coin is very similar in its conception. So we should also regulate them in a very similar way. And that will then also lead to a situation where we really can disentangle what is the impact of the technology, what is the true advantage of the technology, and what probably is only the result of regulatory arbitrage or different regulation. And there we should be very open. So we do not know as a central bank whether in 5, 10, or 20 years people will pay with tokens, or whether they will have very easy access over the internet to their bank account and can do everything very easily, maybe even more efficient than with tokens. So we should be very open, but we should make sure that the environment is such that at the end the technology provides the benefits and not the different type of regulation for same activities, but where we have just different rules. I think this is very important, and we as central banks, we should provide the basic infrastructure, that we have this openness so that these different type of technologies can compete against each other, and then we will exactly get to the point where we can benefit from the technology the most. So lower cost, higher speed, higher safety.
Thomas, it's very interesting because you kept using the word "we should."
Yeah.
Are you doing these things you're talking about? Because you're saying we should, as if we will in the future. I'm just wondering, how is this happening? How are you seeing these innovations or the change in thinking evolve in your work at the central bank?
Well, I can speak mainly about the situation in Switzerland. We believe we are on this track so that we are open towards the technologies. We will see what kind of financial market infrastructures are developing, and whether we should also provide them maybe in the future with central bank digital money, or what we can do to make the core system more efficient, maybe also that we broaden up the access, etc. The more difficult part, of course, is the cross-border, where you have different currencies that come into play, where you have also different jurisdictions, maybe different rules. This is the more complex part. And but I think we should be really open. We are open. We are open in that sense. But we have also to be very careful that we do not favor one technology over the other. Yep. So that we are open which technology at the end is best. And maybe in 10 years there is a new technology that we do not know at this moment, and we should continue this way. But I fully underline again the point, Augustine's point, that I think we should maintain the integrity of central bank money. This is the core, this is the value. A Swiss franc is a Swiss franc, whether it's a banknote or whether it's a deposit or maybe a stable coin. And we have to make sure that there is no confusion about the value of an asset that is where the name is Swiss franc and it's something that is similar to central bank money.
Yeah. Part of the way of getting there, actually, is through experimentation, isn't it? Which, Ravi, you're very familiar with the experimentation in this field in terms of investigating what the future of financial services is going to look like. You talked about this new project that you've launched as well. But the impression that I get from what Augustin is saying, from what Thomas is saying, is that we're looking at a future of financial services which has much more breadth in terms of choice, in terms of options. It also gives you a very steep learning curve.
Yeah, and it's an exciting world, right? I think in addressing all these issues, one key thing to remember always is what is the problem statement? What is the problem we're trying to solve? And that has guided us in all our experimentation and innovation. Yes, some technologies are really exciting and cool, but what does it do?
Yeah.
Right? So we always start with a problem statement. What is the pain point? What is the pain you want to solve? So you take cross-border payments. Today, 8 to 10% of the value that is being transferred is knocked off. Commissions, FX charges, and all kinds of things. That is a terrible waste, right? It takes 2 days or 3 days to settle. It takes a full day for you to receive cash. This is unacceptable in today's internet age. And so the problem statement is, how can you make this cheaper, better, faster? Can you bring down that 8% to 3% and eventually to 1%? Can you have instant payments? Can you have instant settlements? What are the technologies that allow you to do that? Distributed ledgers are one way of doing it. Wholesale CBDCs are one way of doing it. Private stablecoins can do that. Or you could choose to link up real-time gross settlement payment systems. You don't need a blockchain for that. Or you can link up instant payment systems. So you keep an open mind on, as Thomas said, technology neutral, but focus on the problems. I think many of us lose our way because we get carried away by the technology and not sufficiently focused on the problem. The other big problem we need to solve is trade finance. The cost of trade, cross-border trade, is absurdly high today. All kinds of documentation, duplication, inefficiencies in the system. It takes about 40 sets of documents. There are about 100 different players in the ecosystem for a cross-border trade to take place. In today's inflationary environment, we really could do to reduce those costs. Technology can do that. Digital platforms can do that. And sometimes digital distributed ledger technology can do that. So I think we need to be focused on the technology and experiment with focused on the problem, experiment with different technologies, set clear KPIs, what do you want to achieve, and then see how it goes.
Yeah, it might sound like a bit of a strange question, but DPM Heng, for example, is struggling with COVID at the moment. I hope he's feeling a lot better. But COVID's still around. Of course, the pandemic meant that a lot of it, that everybody talked about this story of how there was this sudden rapid digitization and digitalization, right? If that hadn't happened, could we be having this conversation today about this kind of rapid innovation that's had to happen in response?
It was already happening in a big way. I think what COVID has done is to accelerate the pace so that we are here talking about things which we would have been talking, say, in 3 or 5 years' time. But we would be still talking about them. I think it has just accelerated so much faster.
Yeah.
In fact, if the technological systems had not been in place for especially e-commerce and instant payments, I think the world would have suffered tremendously during COVID-19. The economic cost would have been devastating. A good part of the economies of the world were able to ride on the digital platforms and technologies. We got to be very thankful COVID-19 did not happen 10 years earlier. We would have been very badly hit.
That's an interesting point, but there's a flip side to it, is that these innovations, this advance that we've seen in technology so rapidly, the flip side is that things can also unravel very quickly, which I'm bringing it back to you, Augustine. Let's talk about what we've been seeing in terms of, cryptocurrencies, what we've seen happening on crypto exchanges. Earlier, Ravi, you talked about the number of redundancies, and, that's really lamentable. It's very sad that we've seen that, bankruptcies. But it's happening very fast because that's the flip side of technology. This can happen, right? I have this quote from you, Augustine. You were speaking to Reuters very recently, and you said, and you were referring to the current sort of tumult, as it were, you said, you can't defy gravity. At some point, you have to face the music. I'm really curious, what does facing the music look like, and what did you mean by this comment?
Well, this comment and the question that you're making to me just teaches you that whatever you say, it can be used against you. No, I mean, let me give it a little bit of context, and it has a lot to do with what I said before. And that's when I was talking about defying gravity, is that in many of the manifestations that we see today in the crypto world, in some of these problems that some firms have been facing, is because some key precepts of finance have been ignored. Like, we in our hat of financial regulators and authorities that mind the safety of the financial system, there are at least 3 issues that are essential. One is adequate capitalization, adequate liquidity management, and adequate leverage management. When you see, sort of the post-mortem report of many of these firms that have gone belly up, have a lot to do with all these things, I mean, the degree of leverage in many of these transactions is completely abnormal. It can, precisely that's why it says at some point you cannot defy gravity. You are running an extremely risky operation. And if something goes a little bit wrong, the possibility of crashing is very high. So I think that some degree of prudence is very important. I mean, Thomas made the point that we need to regulate this appropriately. A lot of this has been evolving without regulation. A lot of this has been evolving as a way to defy regulation. And, it's not that we're against us being challenged, but at some point behind our conviction in some form of regulation has the value of what we have learned through history, So, yes, you cannot go ahead leveraging without any restriction. Yes, you cannot go ahead without minding your liquidity. Yes, you have to mind how are you going to preserve the capital of your firm. And when I say you have to face the music is, at some point, again, we need to make the effort of not inhibiting the application of technology, but putting it in a context where it is sustainable as we move forward. And sustainable not only in the green sense, but sustainable in the financial sense. I mean, obviously, another concept that we're getting very familiar with recently is the issue of creative destruction. I believe in creative creative destruction because it's an engine of growth, But when you talk about this in the financial world, the real difference is that you hurt many people that in goodwill participated. And that's why, for example, I fully support what Ravi has been doing in tail of putting some restrictions to retail investment in all of this. So that's why I used those phrases at that point.
Well, thank you for giving us the context, and I would never wish to use anything against you. It was a great answer. Thank you. But you did mention sustainability there, and I would like to transition to that subject in the green sense. Thomas, perhaps I could pick this up with you. Climate activists have been appealing to central banks for a very long time on the subject of environmental considerations. But I imagine that it's a challenge. I wonder what role central banks have in mitigating climate risk.
Well, it's a very important question for central bank in general. I think we should reflect what it means for our mandate above everything else. We should see also what are the risks for us in the context that we believe we can make a contribution and that we cannot always deliver on that in that sense. And we should also be aware of the fact that it's mainly something that where governments are in charge of this problem. And I think it's very important that we also realize that we have this transition of the economy, which is extremely important, and we have to have a sustainable transition. So I think for central banks, but in general, green finance, etc., should help in order to have this transition over many years. And we have to realize that we should ensure that this transition is not easy and that we cannot retreat financing immediately from some sectors and believe that we will have a wonderful world then. So it's a very complex situation and we have to be aware of those complexities. So for us as a central bank, we see what is the impact for the mandate regarding price stability, what it means for the risks we have in our balance sheet, whether we understand those risks exactly. So we do a lot of research in that respect. And of course, also for financial stability. So there we put a lot of resources that we really understand what is the impact so that we really can fulfill exactly our mandate. Now, with respect to something that is always interesting is what do we do with our assets? And of course, we try to have a broad coverage, a market coverage, but we introduced already many years ago these exclusion restrictions. So we do not invest in assets that were firms to destroy the environment, for example, or human rights, or to also produce weapons that are not accepted by the international community. So, and in that respect, we are really looking at whether our investment guidance are in line with all the norms, but also all the values we have in Switzerland. And the latest adjustment we did just a year ago is that we excluded from our investment universe everything that is related to thermic coal. So we do not invest in firms that produce coal for energetic purposes. So we do not believe that that will change the world, but this is something where we believe it's not in line with the values that we have in Switzerland. So we excluded those assets from our investment universe. So this is, I think, a short answer from a very complex, I think a very complex topic that will follow us many years. And I think the point I would like to again make is that we have really to, in a sustainable way, transform this economy without creating a world that is then for many people not acceptable, where we do not produce sufficient energy, clean energy at sufficient low prices that will create social problems, that will create big turmoils. So I think it has to be coherent, and it has to be sustainable, not only for 5 years, it has to go for the next 20 to 30 years until we achieve our goals.
Yeah, absolutely. And actually, as you talk about investments, setting the example is an important part of this, isn't it? And whether or not you can get other institutions to do the same thing just by setting your own example. And Thomas, it sounds like you're dealing with a lot of complexity, more and more issues that we have to investigate and problems we have to solve. On that note, Ravi, the opportunity of, for the future of financial services in terms of the technology presents a bit of a double-edged sword. On the one hand, you want to think about the transition to net zero. On the other, where you see all of the innovation in crypto, people obviously point out the carbon emissions of the crypto world. How do you deal with these this imbalance, and how will you engender these values, for example, that Thomas was talking about for the future?
I don't think there is a trade-off. Net zero is non-negotiable. if we don't get to net zero by 2050, which means we must peak greenhouse gas emissions in less than 3 years and reduce greenhouse gas emissions by nearly 40% in less than 8 years and hit net zero. Otherwise, temperatures are going to rise well above 2 degrees Celsius, and we know there'll be catastrophic consequences. So I don't think net zero is negotiable. I think what we need to be focused on is the point that Thomas raised. What do central banks and regulators do about it, and what can technology do about it? Technology must serve the cause of net zero and sustainability. And for central banks and regulators, I think this is hugely relevant. Climate change is the mother of all supply-side shocks. It will make the supply disruptions from Ukraine look like a walk in the park. When there's catastrophic climate change, there's going to be huge disruption, price consequences. Central banks cannot ignore it. If you are to avoid it, the world has to go through a transition which would be bigger than the Industrial Revolution. So that is also huge. Much higher carbon prices, huge change in technology and way of doing things, economic restructuring, business process restructuring. All of that has huge consequences, and regulators and central banks need to be keenly involved in that. For a start, is the financial sector resilient against climate change? Is it resilient against $200 carbon price? Is it resilient against widespread flooding? Is it resilient against breakthrough technologies in the green and renewable space? Because that's going to leave a lot of assets that are stranded. So those are very important questions which the Network for Greening the Financial System, which is a grouping of 114 central banks and regulators, we are focused on. I happen to chair it. And we've been looking at climate scenarios. We've been looking at consequences of those scenarios for balance sheets and what kind of measures can be put in place to strengthen financial systems' resilience to environmental risks. So I think that's huge. The other part is to grow a green finance ecosystem. Here, I think, frankly, not all central banks and regulators can say they have the mandate to do that. Some of us would argue if this is indeed the biggest existential challenge of our times, it's everybody's mandate. Every part of the public and private sector needs to be engaged in this. And to build a green finance ecosystem that can channel private capital to renewables, to new technologies that reduce carbon, that increase energy efficiency, I think are very critical. And we've got to build that ecosystem, provide the right incentive structures and markets to do that. And technology, I think, will play a big part, because I think we need a revolution in green fintech. What we've been doing in fintech, we've got to apply that to solve the sustainability problem. And data is one of the key issues we need to solve. And I think there are solutions and technologies that can help us get there if we apply our minds to it. And I think it's the most worthwhile use of technology I can think of.
Well, look, you've got a room full of collaborators and potential partners. Please speak to Ravi. This is an existential issue. And thank you for being so vocal about this point. I, unfortunately, am almost out of time, and I have to wrap up the conversation, but I hope that we can take at least a question from you, the audience. Before we do, I just wanted to get your view, Augustin, on these very important topic that we were just talking about. The BIS is an institution that connects these banks from all over the world. What is your sort of last word on the transition to net zero and where financial services fits in and has a role to play?
Well, I mean, we're there to help central banks and supervisors in precisely support the transition. Thomas and Ravi have said it extremely well. Let me just mention two examples without trying to be exhaustive. One is for financial system to be a very good contributor to this transition. It needs a lot of information. It needs data. I mean, we can conceptualize the financial system as a way to process information. And in this case, we need to channel savings to investments that are in the line that has been mentioned already. And for that, we need a lot of information. We need to standardize it. We need to bring it together. We have to make it available to people. That data is of the essence to price all these risks adequately. And there is a huge challenge there, and the BIS is putting a lot of its resources there. And the other thing that we have done in a very active way, Thomas also mentioned in helping the investment of some of the assets of the central banks, we have provided green bond funds precisely to facilitate the investment of international reserves of central banks in this process. Of course, we host many of the regulatory committees and so on, and they're fully engaged in all this issue. So we try to support with very practical issues because, as Ravi and Thomas have said, this is a challenge that is just, I mean, where basically failure is not part of the, should not be part of the lexicon.
Yeah, absolutely. Right, I think we have time, well, I'm squeezing out time for one question from the audience. I see someone's hand up, someone very eager over there.
All of the panels today. I think we can all agree that irrational speculation in any asset class, especially in an inefficient market, is a terrible thing, and the retail speculator will be left holding the bag. But the proposition I have for the panel is that, would you agree that the utility of any asset is built on liquidity, and that liquidity is backed by speculation? And if you agree with that proposition, what's the path to create efficient markets in crypto that would allow for responsible speculation to build utility for things like cross-border payments and cross-border trade?
Great question. Thank you so much for that. Let's go down the line. Let's start with you, Thomas, and your response.
I'm not sure whether I really have a good answer to this question. So the question, or in my view, whether we need those non-central bank crypto assets for those kind of activities, or whether we need only stable coins that have some link, some regulated link to central bank money. So in my view, so far, it's mainly a speculative asset, these kind of crypto assets, and whether the true contribution to a functioning or the use case in financial market, this is something else. So I'll leave that open. I believe what we really need is that we have, for those tokenized assets, or those who are then have a function of money, we should have enough liquidity, and we should have exactly the regulation that everybody knows what it means, and what the promise is, and for what purpose we can use it exactly. Thanks.
Thomas, thank you very much for that. Ravi?
I would be wary of equating the utility or efficiency of an asset to its liquidity. Dutch tulips had great liquidity in its heyday. I think what's more important for any asset, financial or real, is what is the underlying income stream or revenue stream? What is the real economic return over a period of time? That is what defines the value of an asset. Now, of course, we differ in our opinions, and that's why there is trading and there is liquidity if there are enough buyers and sellers. So on that point, my question would be, many of the crypto assets, not all, but many, a good number of them that are today being traded enjoy high liquidity. I'm not sure they're backed by real economic value. Is there an underlying revenue stream? I think that's the key question we should all be focused on, that in promoting liquidity and markets in crypto assets, we need understanding of what are the underlying economic streams, full disclosure of those things, which is how securities markets function.
Yeah.
And those are efficient markets. Not every security is worth, but at least there is a market that is based on disclosure, that is based on regulation, and that has liquidity so that people can exit and make their choices. We need the same in crypto world, and so let's not confuse active trading and liquidity for what is the real thing. Thank you.
Thanks, Ravi. And I think, Augustine, that goes back to what you were suggesting earlier.
Absolutely. And just to say, we need to put the horse in front of the carrier. And what Ravi said is just that. If you have a good asset, you have good information, you have all the elements that is needed to have a healthy market, liquidity, volume will result, you know. When you don't have those basic attributes as Ravi defined, you will not get that. you know. So you might have an asset right now that can have a lot of liquidity, but if it's ephemeral, then it just doesn't work. And then is when you have to face the music.
There we go. You come back. So that quote in the end didn't haunt you. You finished the conversation with it, and I hope that you got some satisfactory answers to your question. Thank you. And thank you, gents, for joining us. Thank you for being here. Thank you for making the effort. I'm so grateful. Thomas, Ravi, Augustine, and thank you all to our wonderful audience for your engagement and your time.